The closing bell for January 27th, 2026. I am Keith Harwood here for Yellow Tunnel and Tradespoon. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions, about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and or the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented and the trade ideas, so please do keep that in mind as you evaluate anything that we discuss for your own personal investment or trading portfolio suitability. All right, folks, so with that, we've got a market that is fighting for highs again. There's rotation, healthcare getting hit off of the Medicare rates. So United Healthcare, CVS, Humana getting hit hard today. There's a little bit of a flight from those names. We know that United Healthcare had been piled into both by Warren Buffett and by those that were following the Buffett trade ideas. So that naturally makes sense that there's some liquidation there. People needing to get out thanks to a 20% pullback. Doesn't mean that this is the end of the pullback. Doesn't mean that this is a long-term pullback. We'll have to watch that and see for signs of bottoming action and look for opportunity within that. Overall, market is, as I said, continuing to just grind a bit higher. So we'll look for opportunities there that have the probability of success trade. Alternatively, can look for return on capital. Where I look for return on capital is trades like, CVS, UNH, Humana. If the market decides to unwind a portion of this fall, it can have a big rally. And if it has a continued pullback, then the put credit spread really doesn't make a lot of sense. Where if I sell a put credit spread, I don't have a high probability of success. I feel like I have equal probability that it bounces or fades and a low probability that stays relatively stable, and it may stay stable. But that's not the high probability trade. When I'm looking for a put credit spread, I'm looking for something that is and looks to continue to stay stable. Right now, any sort of response from the market is on the table. And when any sort of response is on the table, I look for a leveraged move, and it may be a lower probability, but it's got the high return on capital to give me a positive expected value in many cases. All in all, market looks ready to break out again. Dip bought. Now we push for a potentially new high, and then the question happens to me on the recovery is what happens at 700? Because at 700, that would be about the symmetrical push through the previous high, where we would naturally see profit taking. We got the Fed tomorrow. Will that have a big impact on the market? Will that help it get to 700? Will it cause a pullback? And then we've got continued earnings season. Will that help push through to the high, or will it again cause a pullback? Beyond that, kind of normal stuff here. Keep an eye on those earnings. We got a couple of interesting ones this afternoon in Seagate and Texas Instruments getting into some tech earnings. And then tomorrow morning, we've actually got a number of earnings that are generally interesting. So we want to take a look at those. Otherwise, general flexibility. 10-year yield pulled back to 4.2 yesterday, bounced off a bit. Establishing the range. 4.2 was previous resistance, now it's support. Bouncing back higher, looks natural, 4.3, maybe 4.35. We'll monitor to see where that goes and potentially see an impact off of the Fed tomorrow. But for now, we're working on establishing the range. Is 4.3 the high? Is 4.35 the high? And does 4.2, which should be support now, was prior resistance, does that continue to hold? In terms of stocks above the 50-day moving average, general participation indication, fairly flat today. It's pulled back. It got up to 70 near the end of last week before we started to pull back. So we've seen some more rotation, not getting into a full-blown bull market. Lows made on Tuesday, highs made on Thursday, drifted back down. There's still participation, but a lot of healthcare names getting pushed below helps bring that back down. And then, of course, we've got the Bitcoin risk-on barometer. So cryptocurrency, buying a little bit here. Yesterday hit a new low, bouncing back today. Seems like we're establishing a little bit higher support now. So the last dip pushed us down to 84, and then we started to consolidate before pushing to a new high. This time we got down to about 86.5, 87 before it starts to look to bounce back. May see a few more days of consolidation or may see a beeline straight up. All I think is going to depend upon combination of currency and risk tolerance in the broad market. All right, so speaking of the broad market, new high, right? So the previous high on January 12th was 696.09. We just got above it. Intraday today, when you look at the flow, we started near the lows of the session. We got up to a new high, rejected it initially, now making it again. So we're at the highs of the day to close the day, people buying back in, maybe a bit of FOMO after missing the dip buying opportunity, maybe something more to it than that, or nothing more to it than that. As we seem to have resolved the Greenland side of things and people start forgetting about a lot of the fundamental issues again. Watching for earnings at this point, it seems. Let's see if that earnings can have a bigger impact on the market. But with the market at the new highs, the VIX is not falling. So we're not seeing call sellers into this rally. We're not seeing put sellers yet in this market. We saw a lot of put buyers last week on the Greenland and European tariff risk. People aren't hedging that by selling out of the money calls yet. So either there's an expectation that this time's different and the upside doesn't want, people don't want to constrain the upside, or maybe because of things like the Dow Jones Industrial Average falling nearly 1% today with the market up, people are reluctant to completely abandon the idea of puts and or might be buying outright puts instead of put debit spreads. You know, a lot of different elements there. And you can see that skew remains high. So we're seeing that lack of put spread buying, lack of rolling up. People are buying tail risk still. People are buying the cheaper hedge. People are not buying for a dip yet. They're still buying for a potential collapse. And not rotating into saying that a dip is the better trade. You know, buying 690 puts and selling out of the money 650 puts. It just doesn't seem like we're seeing that yet. More than anything, it seems like we're just seeing some casual put buyers and maybe some light call sellers, but not aggressively. This skew is still near the lows. So with puts high and this near the lows means calls are high. Out of the money calls have not been sold aggressively by the market. People are not financing the hedge. They're only taking the long put side of things. Maybe that'll change in the coming days if the moves slow down and we start to grind higher and or we just see some consolidation here. Small caps up small here today. 2 days of pullback, rotation in out of small caps as we were pressing towards the new highs. Today, small caps in part being held up by healthcare, down 2%. And I mentioned that UNH got hit hard today, down 20%, down to 280, down to pre-Buffett announcement levels. Everybody that bought after Buffett is losing money. Buffett's still up a little bit, but everybody that bought after Buffett is down, unless you were actively managing the position. Along with that, we're seeing Humana down, also 20%. CVS down, a little less, 15%. Well, note CVS was on the weekly power trader list today. Added it for paid today, looking for this to bounce back as it started to show some signs of stability and maybe the low being in earlier, and then it drifted lower. At this point, earlier today, when we were trading around 75, looked like the lows were in. Implied volatility wasn't up too much. It seemed like an opportunity to potentially sell a put credit spread. Now, I can tell you, I added a call, and I'm already down a little bit because I added it 30 cents ago. But the March 75 seemed like an attractive idea here. And the reason is I want to have some time for this sector to recover. I didn't want to start with February. Frankly, I may look to turn this into a calendar or a diagonal depending upon the behavior over the next couple of days. For now, I wanted the open-ended upside in case it's a more aggressive bounce back towards 76, 77, maybe even 78. If that happens in the near term, these options can quickly double or more. If we continue to the downside, another $2.50, I'm going to lose about 30% from here. If it recovers, it could be $5, $6 pretty quick. So I can make 100% plus. So I wanted to have that leverage because the bounce back is obviously no guarantee. But it seems like a potentially rational thing as we touch the 200-day moving average. If we stabilize here, I go over and I consider a February 20th 75 or 76 call sale just to reduce the amount of premium paid and understand that this is not a V-shaped recovery. It may be more of a U-shaped. And in that sense, I'd like to collect a little bit of theta while maintaining a bullish bias. for now, we'll see how it goes. As we switch over to other ideas within the small caps, we've got energies up today. Oil is up again. Oil is up another 2.5%, pressing another breakout. So the breakout from about 2 weeks ago looked like maybe it was going to fail again, and then we've recovered, and oil prices are going higher. We may be finally catching a trend here, and that's beneficial to XLE. And as I go to like names that we've been seeing frequently, aggressive power trader had SLB back on the list today. This is starting to slow down after a really nice run. I also look at names that we've seen recently, like Chevron. That's been fairly correlated to the moves in oil, or something maybe that's been lagging it a little bit today, at least, is Occidental. Occidental looks like it could have some further upside here and becomes a bit more attractive to me because the risk to the downside it can be set pretty easily in that 43 range. So now I've got $1.50 of downside for 2.5 of upside if I believe in the oil trend going bullish. Along with that, in financials continue to struggle a bit here. Like JP Morgan's a prime example of it. Morgan Stanley has been good on a relative basis, but relatively good isn't really enough to get a lot of people excited. And if financials continue to fall, I worry about Morgan Stanley having a catch-up downside move. We don't have any financials right now coming through with weekly power trader or aggressive power trader. Generally an indication that those financials are not what's being bought right now, which I guess we know, right? Weekly power trader back to energies did have Halliburton. Looks very similar to Schlumberger, up unchanged today. Just to note. And Dover, that's in the industrial, sorry. Let's see those energies for a second. We'll come back to Dover. QQQ generally looks better than the rest of the market today, up 1%, a little bit of risk on, breaking out above the recent highs, not to a full all-time high yet, getting very close. So again, rotation here. Small caps last couple of days pulling back after trying to become the leader bull market. Now money flow is going back to the tech side of things. So we're seeing that money flow into tech, continuing to see positive signs out of semiconductors, making a new high today, very lightly, but a new all-time high. So good bull indicator for tech. IBIT, good potential bull indicator here, seeing positive semiconductor move. We're still not seeing big money flow into AI with Palantir. We're not seeing major money flow into quantum computing. If we start to see that, tech could really take off. But it also may be a signal that the short term people have finally run out of ideas in tech when they start going back into the Mag 7 and buy into Apple now. That has been lagging. The Mag 7 just hadn't been able to participate, IBM. Or, the big bear, Netflix. Still holding near the lows. If Netflix starts to squeeze, that may be a contraindicator for the market, showing that we're out of ideas. There's no real value out there, so just buy what looks cheap on the chart. Something that used to trade $125 and is now $85. That means it must be on sale because it is 30% down. Doesn't necessarily mean it's good. It's on sale for a reason. People haven't been buying for a reason. So I always try to remind myself of that yes, on a short-term basis, this could squeeze to $100 a share. Doesn't mean it's fixed whatever issues it's had. And since we already have earnings and they were weak, if I'm waiting for a fundamental input to give me justification that Netflix has gotten the turnaround in place, I got a couple months before I'm going to see that information via earnings. All right, so let's run weekly power trade. We got the SIBO Global Markets, options exchange. Had a nice run on the breakout, now pulling back. Should find support here around 262.5. We're right there. I think this makes a lot of sense for a put credit spread, except for there's no premium. 30, I guess it's 46 cents now for a 262.5, 260. It's close. It's illiquid. It's not great. Honestly, with SIBO, I'd probably go with stock if you like it. Buying it, stopping out around the 262 level, looking for the bounce back to 277. So $4 of risk for $11 of potential profit. If you don't like stock, I wouldn't trade SIBO. CLX, You know, ironically enough, CBOE doesn't have great liquid options. Yes, we'll check on Starbucks, Ted. I'll bring that up here after we run through these other guys quickly. Clorox stabilizing here above the 100-day moving average. I like Clorox here. I'd use the more passive 108.35-ish range, you know, the previous high from November as the stop out point, target of around 120, $4 downside, $6, $7 upside. Again, not the greatest options market. It's reasonably tight, but I'm looking at $5 increments and monthly options. So kind of fits again better as a stock trade. With regards to CVS, I'm looking for that bounce back that I mentioned already. If it gets towards 78, I think that's a good profit taking zone. And if it stabilizes, rotating into a calendar, you know, the put credit spread can still work. Needs a little bit of a bounce back to get back to where we were looking at it earlier this morning. But overall, a lot of the selling pressure seems to have reduced here. Now, when I look for some of those indications, a lot of it is on volume. So this morning, there was big volume on the buy side. And some big volume came in midday around 11:30. And then we stopped that and had a number of bars in a row with buying. And then looking at the 1 minute bar here, we can go to a 5 minute. A lot of this volume has started to fade here. So I think the big movers really took care of business here in the first 20, 30 minutes of the day. I'm going to watch to see what the volume does on the close. If the money flow on the close is good volume buying, gives me greater confidence. If it's big money flow selling, it's not a good sign. So just got to watch those sort of elements. Dover industrials unchanged. I mean, ideally here, I'd look at a put credit spread selling the 200 strike, but we don't have weeklies. We don't have a ton of premium. Well, there's decent premium for February, but there is also earnings in 2 days. So generally between the earnings more than anything and the lack of weeklies, if there weren't earnings, not really my style. Halliburton, 10-day moving average is providing support. I think this can be used via a call vertical or a stock trade. If it fails below the 10-day moving average, that's a bad indication, but oil's bullish, so that's a good sign. Something like a 33.35 call vertical in February would give some leverage without having to use too much capital. $1.05 right now. That can appreciate nicely into a continued rally. And then Hasbro, another one without weekly options, supports really at 84.5. So $5 downside is breaking out. This is the lowest point I would use for a stop. Somebody more aggressive could use 87.5, $2.50 of downside. Again, though, no weeklies. Okay market width, better for a spread than anything. Just going to tie up capital for a longer period of time. If looking to sell like a put credit spread or buy an in the money call vertical, it's going to take time for that to pay off. So again, kind of looks more like a stock trade. On the aggressive power trade list, we got Corteva, basic materials. Just it's in a bull trend. Options wise, very limited here again. I think it's more of a stock trade. The markets are tight, but they're $5 wide in a $70 stock and makes it a little bit tougher, where if I think the ultimate upside's around just over 75. Live Nation, rejecting the 100-day moving average for now. Once it gets above the 100-day moving average, there's greater upside. Could look at a call at that point. If it doesn't go, then 140 looks like a target price to the downside. So for now, a waiting game for me in Live Nation, and then PM, since I already touched on SLB, is just pushing. Now, this is where I always pull up Altria and British Tobacco just to see if there's something maybe better when you've got PM pushing. They're all pushing. Altria looks the cheapest, quote unquote. Resistance in Altria would be around 67, 68. PM being the leader. If you prefer that zone, going into leadership 174.5, it would be my stop out point. All right. we ran through those fast. So if you want me to circle back on any of them, let me know. But let's get to the earnings side of things. And we'll start with Starbucks, even though it's tomorrow morning. I'll do tomorrow morning, and then we'll come back to this afternoon. Starbucks is currently trading 96. Normal earnings moves in Starbucks have been on average 2%, and sometimes we get 7 or 16. So if I'm looking for the predictable normal move, I'm looking small. There's a chance of a big move. About a third of the time we have a big move, 2/3 of the time a small move. So if I'm looking to trade this off of the fact that we're pricing in a big move or a little bit bigger than the normal move, I got to lean towards the iron condor and say, okay, well, maybe about 40% of the time or 35% of the time I'm going to lose on this. But if I can sell a 6% move, $6, by selling a 90 put, previous highs, and selling a 102 call, 6% away, and get enough premium, it can work. And 102, 103 call vertical is 23 cents. A 90.89 is 23 cents. So I got to stay in the range 54% of the time if I'm selling something for 46 cents. It's got a slight positive expected value, because I think it's about 65% of the time we stay in that range. Maybe a little more, because even on the big moves, sometimes we only go about that 6-7%. The big move is a possibility. This looks like an iron condor candidate, if anything, to me. We're expecting 90 or 102. History has stated that Starbucks is more likely to move $2 to 94 or 98. There's an outside chance it gets the big move, so I got to define the risk. And if tomorrow morning it opens up at 92, I'm in good shape with a 90.89 put credit spread. Call credit spread clearly dead at that point. And if tomorrow morning we open up at 85 because it had a bigger move than expected, one of the second largest in 2 years, I got to accept that that was the risk I was taking. That we have, one of those 10 to 15% scenarios where I lose what I was potentially going to make. So with Starbucks, iron condor certainly looks to be the most attractive approach to me. Seagate Technology, tech. Honestly, I'm leaning bullish. More often than not, bullish on the earnings. In the last 2 years, 2 bearish, the rest bullish. In the last 3 years, 4 bearish, the rest bullish. In the last 4 years, starting to get back to when maybe the company wasn't as successful. But in the recent history, it's been more bullish. Last earnings was more bullish. We're pricing in a big move, 10%. After a 20% rally the last time, if we have bullish, I don't expect 20% again. I'd expect more in line with normal, 6-7%. If I'm looking for 6 to 7% to the upside, we're talking about 20-ish, $20 to $25. Something below 400, more likely. If it's bearish, I think there's some significant downside here. And it's harder to pinpoint, $30, $40 to the downside to get support makes some sense after the run we've had over the last week. I'd lean towards a slightly bullish call vertical, not even go with the call, or go with the call condor, or call, not condor, call butterfly. But I think going wide here, it's building up some open interest at 400, 375, 400, 4.25 call fly is trading for around $4.50, around $4 actually. If we have a normal size move to the upside of 7%, I kill it, right? These are worth about $19. This is worth about $19 when you do it twice. So I'm basically paying the price of a 4.25 call, which seems pretty aggressive, to potentially fall in that range. So if I pay 4.25 for $25 wide, I got a chance of tripling or quadrupling my money. Again, to the downside, I'm worried that there's greater potential risk to the downside because of the recent price action. Upside seems more likely. What would kill me if I went in this route, and I'm just not going to trade Seagate personally, is that if it does go to 4.25 and I put on the butterfly, because then I was right to be bullish, I just wasn't bullish enough. And that, brings back memories of, which one was it? Was it MRVL? Was it? Not MRVL. There was a different one. AVGO? No. One of the other tech companies, and I'm blanking on which one it is right now, had one of those killer earnings where it went up like 30%. Maybe Seagate has that opportunity. That would be my only hesitation towards the butterfly on the call side. Texas Instruments wise, looking at an average move around 6%. About half the time we move between 5 and 7%. All right, we get a little bit below, a little bit above here, but about half the time we're looking for 6%. $12. $12 to the upside puts us just below 210. $12 to the downside puts us right at 185. Option open interest. Big building open interest in volume today at 220. These are the over excited version of the bull case. 185 on the downside and 187.5. Pretty good volume, pretty good open interest, and then further volume trading today all the way down at 175. That seems like a lot. 50-50 shot of moving 6%. So if the price is right, it works. If it's not, it doesn't. 192.5, 185, 177.5 put butterfly. It's about $1.10. 202.5, 210, 217.5 call fly. It's about a little under $1. So let's call it $2 total for $7.5 wide butterflies. If it works, it's a triple. If it's a 50-50 shot for a triple, it's worth it. So positive expected value doesn't mean it's a high probability. I think it's about a 50-50 shot of tripling the money though. So looks a little bit better to me than Seagate. About the same odds of success and potentially same expected value, or sorry, lower odds of success, around the same expected value of Starbucks. If you want a higher probability, I think Starbucks Iron Condor makes sense. The general rule of thumb is that the Iron Condor is going to have a higher probability of success. Texas Instruments has the higher potential payoff, just going to happen less often. Going into tomorrow morning, we got ASML, $1,500. Just to note it, I don't trade $1,500 stocks unless they are slam dunk predictable. A third of the time or a little more, it moves about 7%. It's going to be a whopping $100 move, seems likely. Potentially as much as $250 move. If I even try to do a butterfly for a $100 move to target like 1550, a 1500, 1550, 1600 call fly is 33 minus 37.30, so 430 credit. It's about $4.5 or $5.5. And so yeah, it's got a multiple to it. Big potential payoff. But it's not a predictable move, and we've already run so much. I mean, $150 puts us back to where we were after the European tariff concerns. So it's hard to pinpoint it, but if I was going to try to, I'd be looking around $100 on the move, and then cross my fingers. Let's move to something a little more accessible, still high price, GEV. So one thing I like to check with stocks like GEV is it correlated? In the last 7 earnings, prior to this last one, we had bearish in July, bearish in October. With GEV, we had very bullish in July and slightly bullish in October. So this big bear move here in GE doesn't necessarily have any correlation to what happens in GEV. Sort of the net of it, right? So GE in July of 25 was down small, GEV was up big. In October of 22, it was down big, and GEV was up small. So I have to keep them completely separate and just look at the history and say this is normally a 3% move with the outside chance it moves 15%. And we're pricing in 4%. Unlike Starbucks, which is pricing in a really big move, like 6-7% and normally moves small, GEV is pricing closer to the normal average move here, slightly over. I don't think there's enough of an edge there. So just on a comparative moment, SBUX normally moves that small amount, but we're pricing in 6.5-7%. Actually, closer to right around 7%. GEV, it's pricing in closer to the average normal move because of that potential tail risk, a little bit above it. Not enough for an iron condor, generally speaking. So, and particularly with GEV, while there are a lot of option strikes, they are not liquid. We're looking at $4 wide markets in a lot of these. Some of them are $1 wide. Probably means that there's somebody actively buying or selling this contract at this exact moment. But the rest of them, where there's no active engagement, they tend to be wider. You got some tightness in the 700s and some tightness here on the 680s. Outside of that, it's not a liquid enough market to trade it, but it is something to watch because it has been an interesting stock, and I think maybe after earnings there's something interesting to do there. GD, fairly predictable here. 3.5%, right in line with expectations. 3.5% is right around $11. All right, so for an $11 move, we're looking at 355 and 377.5. 355, it's light open interest, but across the board. 377.5 has no open interest. But if I'm looking for a move here, it's again back onto a double fly because I have a generally predictable move. And I can try to piece it together if I can get the pricing in. But I'm going to pay an edge to get in and pay an edge to get out. So if on the 360, 355, 350 put fly, just as an example side of it, I'm paying probably 50 cents, or I'm valuing it around 50 cents. I may have to pay 60 to get in. Now I'm paying 20% more than value just to get in. I'm going to give up a dime to get out. I'm giving up 20 cents on entry and exit, and that hurts a little bit. So maybe more predictable, but in terms of execution ability, I think it has to be considered a pass. Then you got ADP. Very traditionally, small moves to the upside. Last earnings was the outlier. Big move, and it was downside. 2% is the norm. Pricing in 5% this time. Pricing in something more like we saw last time. So if I want to trade this one again, I look at the outlier and say, well, maybe the outlier doesn't happen again. If I go for 6%, it's $15. Could sell a 270 call. Could sell a 240 put. If I can get enough premium, in this case it's 33 and 35 or 25, it can be worth it. But it's 33 and 25. It's 58 cents. Max value is $2.50. I don't think it's worth it. Even if the market's pricing in a big move, it's not looking for a huge premium to those put credit spreads. So as I look through all of these, I'd say the ones that make the most sense are Starbucks, because the iron condor premium I can collect. And then maybe Texas Instruments, because I have a generally more predictable move. And Seagate looks like a predictable move if it's to the upside. If it's to the downside, I think that the range of possibilities is too great. So if you like the bull case, I think you can look at it for a predictable state, around 400. But if you're looking for the bear case, it becomes a lot harder. Especially given that we came from $150 less than 6 months ago. Some bad happens and it could be, UNH all over again, 20% down. And it wouldn't look that bad on the chart to pull back to 300 once you look at a weekly. Say, okay, well, we just unwound 2 weeks of move. So the last 2 weeks we're overexcited. But if they're right, a little bit of limited upside, but I think it looks generally favorable that direction. All right. Other stuff moving today. XLV is clearly the big one. Emerging markets bullish. Jets getting a little bit of a pullback today. Breaking support. You know, Delta had been looking really strong. You know, early in the year, started looking okay after earnings, then pulling back again. I don't know that I believe in the airlines for the moment. There's too much concern there. Boeing just had earnings, a little bit weak today, had earnings this morning, bounced back after earnings, so seem to be setting up some support here around the 20-day moving average or around the August high, whichever way you want to look at it. Looks like support is around today's low. Tomorrow, if we break today's low, downside looks to be 225. If that holds for another day, looking for around a bounce to 250, nothing crazy, but sets up a put credit spread starting tomorrow, I think. You know, I think that's where we're headed in Boeing, is either bigger tail risk to the downside or likely drift higher. It effectively turns into the standard market skew, which is a left skew. What that means is that there's a expectation of drift higher, but capped upside. And if it goes down, it can go down a lot. That's the normal market behavior. We normally go up a little bit every day on average. Distribution says, okay, well, we're going to go up 0.03% a day on average or something like that. Or 0.05%. Let me think here. Yeah, about 0.05% every day. That's the average daily move. That gives us an appreciation over a year of about 10%, 11%. But on those down days, we can see 3%. And on those up days, we normally don't see, 3-5%, barring a big fundamental input, and happens every once in a while. But, just like we saw last week, when European tariffs were on the table, we got a bigger move down. And then outside of that, we recover over the course of a week. So it takes a week to make up for a day. And I think that's what we're dealing with Boeing. Could take a week to go up $5, $6. But it could take a day to get down to 230. Probably not 230. That would be pretty aggressive. Maybe 235. Other stuff moving. We got the dollar showing further weakness here. Breaking lows. Gold just can't be stopped. This has just been insane. Watching gold, watching silver. I've been staying away from it. At this point, I think unless you've been trading it and making money, where you have really good confidence in a new way to trade it, I continue staying away from it. I think about my general play here, if I was in silver, would be, oh gosh, this implied volatility is way too high. At 112%. Realized volatility has been 60, 50. It's turning into a GameStop style implied volatility where there's this chance, sorry, wrong term there, February 18th, February 20th, that it moves $20, certainly over the course of the next month. That would certainly be within the realm of possibility. On a day-to-day basis, it's not moving 120 at 102% realized volatility. That's 6% a day. We're moving 2-3% on most days. Do I want to buy a calendar buying expensive volatility, expecting it to stay volatile for a long time? Probably not right now. To the downside is where the implied volatility can get hit. So much like I looked at before, thinking about like HUD 8 back in the day, when I was thinking it could pull back. Look for that implied volatility to have that potential downside and a pullback. That means that for SLV, a pullback, I look to target 75 with a butterfly, like a wide butterfly. because that's where I'm going to be short volatility on a break and then look to exit. Not to necessarily hold it just because it pulls back. So like a 90, 75, so many strikes here. 90, 75, 60 put fly. It's 530 minus 246, so 385. Cheap 60 put to just cap it in case. It's not cheap. It's still $3, but if silver pulls back, it's the way to play it to me. If it keeps going higher, implied volatility may rise, but realized volatility isn't catching up yet. A lot of this is like over exuberant, maybe FOMO, buying calls, paying a ton of money. I mean, look at these. The 110s are over $8 for next month. It's a good amount of premium. And if it works, it's great. You get 2 days of pullback, and it's not. I mean, let's compare here. When we were trading 85 on January 14th, and then over 2 days, we pulled back. So let's look at the $95 calls. On January 14th, when we made that initial peak, they were trading $5.50. Within 2 days, they were down to $3.50. So down almost, 30% on a seemingly minor pullback, right? From 85 down to 80. $5 pullback, 6 or 7%, and I take a 40% loss. Probably even more now on a $5 or $10 pullback, and that's well within the realm of possibility. So those things still scare me right now. Suncor, wow, bullish. I mean, being long is working. 50, I mean, below the 10-day moving average is my concern point. I don't have a personal strong opinion on whether, if we're kind of repeating this, where we go and then we stabilize for a long period of time and then pull back, or if we go and then keep going like we've done now. Looked like we were going to start stabilizing a week or two ago. Applied volatility is 27. That's the highs. Earnings in a week and a half. Not enough time to sell a put credit spread, because if I go into next week, I'm exposing myself to the earnings risk, which is normally can be up to 5%. And that puts 49 in play. So vol premium for the earnings. I mean, max 2 weeks, I guess. February 13th. No. No opinion, I think, is my net result here. I mean, I'd say yes, it's bullish. The downside seems pretty limited. It may stabilize here and just go into earnings without a move from here. It may continue for a little bit more before earnings next week. But I think it feels late in the game. If long, looking towards the profit-taking spot, because unless I wanted to hold it through earnings, which I normally don't like holding things through earnings unless I'm looking at it as a year plus type investment type trade, I'd want to be out by next week anyway. In the near term, I'd use the 10-day moving average as a support, but if it touches it, it's probably going to kind of stabilize there and then just go into earnings flat around 50, and then we'll see where we go, right? So I don't see anything from the behavior that gives me a edge over the market here. I feel like I'm just saying, okay, finally jump on, but maybe too late. And if on, either a trailing stop or just take some profits and move on to the next idea, Let's see. So other stuff moving today that's maybe of interest. GM had earnings. Let's pull them up. So GM had earnings this morning, nice and bullish, pushed to a new high. Should set up some support here around 83.5 as it continues to see buying throughout the day. It's not a huge amount of premium. It's a little lower than my normal target, but an 83.81 put credit spread for 17 cents. 3 days to just say it's not going to break back down below the previous high. Even if I throw out the January 8th move, then it's 83.5-ish as the previous high. Feels like a safe way to make money right now in GM. Could go out to next week and get a little bit more premium, up to 20 cents for an 83.82. This week it's only 11 cents. So yeah, probably next week, 83.82 for 19 cents. Feels like that should be a relatively safe look for GM for now, unless something weird happens with tariffs again, which can always happen. And then, honestly, the biggest thing for me is still seeing UNH and CVS and Centene. So, here we go. More managed care with Centene. Down last 11%, but still a significant move here. And I think these are just ones where the near-term distribution becomes wider. And so if CVS implied volatility is only up 2.5%, it's a lot for it, but it doesn't feel like enough. UNH implied volatility is down today because it had earnings. Still somewhat elevated. Centene implied volatility, they have earnings next week. So CVS kind of gives me something that, while implied volatility is a little bit elevated, they also do still have earnings, so that vol premium should maintain, and maybe they actually are get an expectation of a bigger move as they update on how much the new policy of the managed care rates impact their business. They may have enough time, should have enough time with 2 weeks to update on that. So actually, I didn't look that closely at this with UNH intraday. Is it the same as CVS? Yeah, it's kind of the same as CVS, except for sold off in the open. CVS tried to be stable on the open. CNC sold off on the open. So, I don't know. I still like CVS, frankly. I think it makes more sense than the others. It's just a matter of may or may not work, right? I will say I'm now up slightly on my 75 calls. Yay. Now that we're back above 72. The put credit spread's still down a little bit here. We'll see if that bounce back continues today. And if it closes around, we're only 3 more minutes left. But the way that it's closed has actually been decent here. It didn't push to a new low. We had the bounce back right before the final 2 hours of the day, and then stable. So yeah, I think this could be an interesting one. Hopefully pays off. But it's not a 70% probability of success for me. It's one of those things where I feel like I've got a coin flip for a 150-ish% return, or a little bit better than a coin. Yeah, probably about a coin flip for over 100% return. And if it doesn't work out, I manage the trade. I adjust tomorrow, the next day, whenever I start to feel like the bounce back is either enough of a bounce back for now or no bounce back and it's not going to happen and I want to sell a call to reduce my premium paid. All right. You only got about 2 minutes left, so I'll just do a quick update. Marathon, I'm still in it. I'm glad that it's bouncing back today. I'm losing my confidence. I may just take my profits and go on this. I'm up 50-ish or something like that percent on those March 12 calls from buying in near the lows, which was a good timing on my part. Not necessarily for any reason other than seeing that crypto looked like it had stopped falling and taking the shot for that move towards 12.5, 13. I'm still looking to see if it can get a bigger recovery, but if it doesn't, at least I've got a little bit of money in my pocket either way, Actually, and then just to note, Microsoft is bouncing back here, but they've got earnings tomorrow. So we'll talk about their earnings tomorrow morning. look to see if there is a trade there. And beyond that, I mean, normal move here is about 5% or a little less. We're pricing in 5%. So we'll take a little closer look at that tomorrow morning, though. Okay. All right, guys. With that, I will let you go. We'll see what happens with some of these earnings and see how things shift tomorrow and see if the focus moves away from reducing risk in the healthcare names and start back into, who knows, tech names, risk on, or something like that. So thanks again, everyone. See you tomorrow morning.